What's up, outliers? Eric here. We're going to talk about zero DTE strategies for small accounts. For those that don't know, I trade zero DTEs literally every single day. It's a big part of my book. And in general, I think they're very difficult to apply in smaller trading accounts. But the goal of this video is to walk you through a little bit about the background of zero DTEs, how it can make sense, and then to give you some ideas on how it might be able to fit into your portfolio. But it's a tight squeeze. That's all there is to it. I'm thinking of this from the context of like a $10,000 account and under. But ideally, we would be trading something way more than that. And you'll see why that matters so much. So let's dive straight in and get to it. So what are zero DTE options? Well, they're essentially options that expire the same day. So today's the 10th of September. If I traded, which I did, zero DTEs, it means I trade options that are expiring the very same day. That's all. And what's the idea behind this? Well, a lot of people think it's fast, easy money, which I guarantee you it is anything but that. However, there is a significant opportunity available in zero DTE options. So here are a couple studies that you can take a look at. This is called Zero DTE Trading Rules. And then this one is called Retail Traders Love Zero DTE Options, but should they? And these talk a bit about the phenomenon of zero DTE options. And I'll explain exactly what this is. And for those that are in the Patreon, you can download, I have a file that kind of compiles all of these studies for ease, but these are all free and accessible for everybody. You can just look them up on SSRN. So what's the profit mechanism for zero DTE options? In this case, I'm primarily looking at variance risk premiums. What is that? Simply put, it's the tendency for implied volatility to trend over historic volatility. I have a video that goes into zero DTEs in detail that I'll link to below. It's literally an entire playlist, but there's one specifically called Master Zero DTE Options that I'll share with you so that you can learn way more about the background. I want to kind of build off of that, spend less time on the theoretical background and talk about the application. So this is essentially variance risk premiums. And what you'll notice is these yellow lines represent implied volatility, which is forward looking. These white lines represent historic volatility, which is backwards looking. And you'll notice that in general, the yellow lines are above the white lines. In general, there will be periods that the white lines come above the yellow lines, but it's not always. And you'll also notice some very specific qualities about the lines when it does that, which we'll talk a little bit about more in detail. So what's going on here? Again, not to rehash the other videos, but to get everybody level set, this is simply the tendency for options to be priced too richly with respect to volatility compared to what the market ends up moving, which again, that's what historic volatility is. So we're expecting and pricing in more movement than is actually happening. And this is very persistent. Again, you can check out those studies, not take my word for it. I will always do my best to connect you with resources that you can look at for yourself. And if we look back over a longer term time frame, again, you'll see that this is generally the case. There will be periods where it's not. Again, take a close look at those periods because it's an important factor. So that's in a nutshell what zero DTE options are all about. So what's the signal? Exactly what we just talked about. Now that signal can be caused by event related things. So maybe an FOMC announcement is coming out and that's driving up volatility, or just the overall persistence of variance risk premiums, which again is a documented phenomenon. Now, one really important admin note here is for people that sell volatility, very often hear the idea of, we sell vol when it's high and buy when it's low. That's actually not exactly correct. It's kind of a simple way to create a rule of thumb, but it's not representative. And I'll show you what that means. Really, the signal and what matters in this case, what we're measuring is IV over HV. This can happen if implied volatility is high, or this can happen if implied volatility is low. And I'll show that to you. So if we take a look at this period here, we can see over the past year, which this is what's showing you, again, that's what the aggregation is of the chart. You'll see that this is actually the highest period of volatility over the past year for short-term vol. And then for 30-day vol, it's the second highest compared to this period over here. So volatility on a relative basis is very, very high in this instance. Yet realized volatility or historic volatility is even higher. So this is an example where if you sold volatility when it's high, it didn't matter because you still got beat out by price. So again, the important is the relationship between implied and historic. That's actually what these purple lines plot for us. I can get rid of all these yellow lines and just have these purple lines because it's charting the difference for the same time frames between these. And again, for those that are in the Patreon, there's a download available in the shop that's free for all Patreon members that has this very thing script for you. It's one that, as you can tell, I use all the time because it helps me visualize this. So that's the signal. Now, when it comes to capturing, I'm going to use things like short options. I use short strangles or short straddles, but that's not going to work for small accounts because if you are on a regulation T account, it's going to be probably hundreds of thousands of dollars. If you want to sell a 20 delta short strangle, for example, in SPX. So then we have to think about, and for those that are curious, in a portfolio margin account, it's like $75,000. So that's going to be heavy for most smaller traders. So then how can we think about a way to run this approach? Well, I back tested it for us so that we have some data that we can look at. Again, the way that I do this is ideally built on a process that's deployed long-term. So that's why back testing something like this, it actually doesn't involve a lot of discretion. It's kind of generally running the strategy. And that's why you'll notice I have this concept of occurrence-based and careful discretion because I am still discretionary. There are certain conditions that based on my personal strategy will lead me to enter or not enter or delay an entry, but you have to be so careful about it because the performance of all this specific kind of strategy, it's kind of an aggregate numbers sort of thing. As you have more and more occurrences, the output will approximate towards the value of the strategy. So if you start cutting too many occurrences because of discretion that's skewed in some way, that will drastically impact your results. So using discretion is completely okay, but you have to very carefully track it so that you're not killing the output of the system. So let's take a look at a couple studies. Again, the other videos in the playlist have huge study sets on this. So I'm going to skip through some of the high points. I already know based on my studies that the better entry times are later in the day. So this is looking at Eastern Standard Time, essentially 1330 or 1400 entry periods tend to be best. So I carry that through the study. This is just looking at short calls, deltas, long call, short put, long put deltas. The lot size in this scenario is looking at a 2 lot. And then these are all going to be 0 DTEs. There's no max profit applied to any of them, but there is a stop loss applied. And again, this is based on what I've seen previously that not having a max profit tends to increase the performance. You can, again, go back to the playlist that I referenced before that goes to all of this super far in detail. So this is looking at a 10 delta strangle, 15 delta strangle, 10 delta strangle, 15 delta strangle at 1330, 1400 respectively. And you can see that these are good performing strategies. The reason why I show you the difference in a half hour between these is to show general robustness around the time frame. Then I take a look at adding wings. So I have a 10, 15 strangle, but I'm buying the 5 delta wings for both. I do that at 1330 and then 1400. You could see at 1330, it does not do well. You can see one important difference here though. Take a look at the width of the spread, 5 points versus 10 points. Take a look at the change in P&L. It's much, much, much higher performing at the wider spread with no P&L management applied. Then when we take a look at 1400, which is, again, I'm just picking a time period. I'm not trying to optimize it heavily. I'm just trying to show you a concept. So if we take a look at 10 delta, 15 delta, again, doing the entry at 1400, notice that the performance increases massively for the kind of wider iron condors. Well, really for this, but again, take a look at the width of strikes and take a look at the impact of performance. So the first takeaway you can grab from here is that wider is better. Now, this is going to be dependent on what your account can afford, because if you're doing something like a 15 delta and 5 delta, we can look at it together really quick. Let's grab, I'll use a 1 DTE. It's not going to matter because it's a defined risk trade, but let's sell this 15 delta and buy the 5. And then let's do the same thing on this side. We'll sell the closest to 15 and then we'll buy the 5. And then let's take a look at what that grabs us for margin requirement. It's $4,000. So even if you have a smaller account, again, if you have a $5,000 account, this is now your entire account in a trade. That's kind of dangerous. And the other problem you have is if you have a $5,000 account, you're risking 32.65, which is way too much. So you might have to start start playing. And that's why I show you with a stop loss. And you actually notice it really improves the performance of the strategy for both. Now, a really important note, this is in a frictionless environment. This is not including fees. This is not including spread, which would absolutely chew these to pieces. The performance for all of these will contract meaningfully. So one of the ideas is to decrease occurrences, number of trades. It's to decrease the number of legs as much as possible. And we want to try and touch the trade as little as possible once it's on, because fees are quite detrimental. Now, the last thing I wanted to show you, however, is that the 10-point wide 20 delta did not perform quite as well. It had a decent win rate, but still underperformed. But again, the 20 delta, 5 delta without profit management absolutely crushed the 15 delta, 5 delta without profit management. So there's absolutely an important argument to be made for managing profit on the iron condors or the spreads that are being used. But again, in a non-frictionless environment that includes fees and transaction costs, there is absolutely a cost associated with it. So let's talk about a couple other things really quickly. I want to highlight this path dependence, and I actually asked you to pay attention to this earlier. Path dependence is essentially one of the properties you'll find in returns in general, and volatility really amplifies it because volatility does this thing called cluster, where when it goes through a transition, it tends to hang out in a new place for a little while before it transitions again. So if we take a look at short-term volatility, which is the white line and the bright yellow line, you'll notice that when it's breached, it tends to be breached for a few days before it comes back down. So for example, in this case, December 20th, it was still okay with slight VRP. Then on the 21st, we actually turn negative. Then if we go to the 22nd, we're still negative. If we go to the 26th, we're negative. Go to the 27th, we're coming back to break even. So what I'm highlighting in this instance is, for me, if I get stopped out and I know that volatility is starting to expand, I actually might not place some trades on additional. That's the discretionary portion, because I know volatility tends to cluster. It's very infrequent that you'll see where this white line like this here, where historic volatility exceeds implied and it's only for a day. It's infrequent that I see that. So a lot of the times when I'm trading variance risk premiums, I will wait until historic volatility on a short-term time frame is less than implied volatility. Because again, if you just do it ad nauseum, completely indiscretionary, you'll get these results, which are still good, but you can optimize them a little bit. So 0 DTE for beginners and specifically small accounts, I think that they absolutely can be applied, but they have to be very, very, very carefully used. Because for example, even if you have a $10,000 account and you look at the 15 and 5s and you're like, wow, that's pretty good, $49,000 return on a 2 lot. Well, here's the problem. The max loss is $1,650. So even if you have a $10,000 account, that's way too big of a loss on an individual trade, because these again are path dependent and you need a number of occurrences in order for the returns to approximate. So if you have a $10,000 account, you might actually have to look at a slightly suboptimal 10 and 5 wide so that your max loss is now contained to $860, which I actually would argue is still a little bit too high. You might have to be even tighter than that. So the main issue that small accounts are going to find when trading something like this is the ability to put on something that is logical, that makes a decent return, that still captures the benefit of what the structure is and what the profit mechanism is without giving up too much profit in order to reduce max risk. That's the main issue that these are going to run into. Now, the last thing I want to highlight is, for me, if I'm going to let them go into expiration, it has to be European style options. If it's not European style options, then you have the risk of assignment, and that opens a big problem. The other benefit to using something like SPX as compared to other products, you can use something like XXXSP, which is slightly smaller. It's going to be less liquid, and the problems you're going to face in this in terms of spreads are going to be exacerbated, but it's also doable. But the other benefit you get is section 1256 of the tax code, where 60% of the gains are going to be long-term and 40% will be short-term, which will be at your rate. The last note is that when it starts to suck is when it's important to keep doing the strategy, because the way that this works, if you follow the math on your average win, it's $200 for, I'm just picking this 10 delta here randomly. Your average loss is 465. So as soon as you have one loss, it's at least wiped out 2 wins. And again, that's in a frictionless environment. It probably would be a little bit worse than that. If we're looking at the spreads, it's even worse still. If we're looking at the $10 shorts, $5 longs, you have $107 average win with $220 average loss. Not terrible. But then if you're doing the 15 and 5s, 220 average win, 714 average loss. So really, really difficult to make these up without giving yourself enough runway to get enough occurrences on. So another thing that I like to look at, and I can look at in a future study if we'd want, is the propensity for average losing streaks, so that you have an idea of what that looks like. I use that pretty heavily in all of my strategies so that I can at least have an understanding of what is likely to occur. It's not limited to that. You can always have longer streaks, but it gives me some ideas so it doesn't feel like I'm flying quite blind. So hope the video is useful, specifically 0DT options for small accounts. It's a tricky prospect, but can be done. SPX, again, is the preferable tool in my opinion, but something like XSP is also viable, and it will trade at a 10th the size as SPX. It'll give you similar performance overall to what I just showed. The difference is the spreads will be worse. So your actual performance will be a little bit different, but otherwise the rest of the theory and all that stuff applies all the same. As always, any questions, let me know. Be an outlier. I'll see you all later.